Welcome to ShortView Trading. This is your morning market hit for Monday, 15th of June. What matters today and this week for traders? Well, the market's mood clearly switched last week. From one of ebullience and bullishness into the Fed meeting, the buy on the rumour, sell on the fact type price action, with new intraday highs reached on Tuesday and Wednesday in the S&P 500. From that, switching into a fearful mode, selling off sharply. As you'll have seen over the last few days, the S&P has broken its key 200-day moving average. It's broken below its September and July highs from last year, and it's now finding support temporarily, potentially, at around its 61.8% retracement level from a Fibonacci ratio assessment. As you'll see now, that's the key level, 29.30, roughly where we're trading as we're recording this video. Below that, there's clear support at the 50% retracement level that you can see in front of you now, 27.80-ish on the S&P futures, and then at around 27.30 to 50, which was key support in late April, early May. So on the surface, it seems as though the reason for this sell-off is being given. The narrative in markets is about US infections rising in certain states, and of course in China over the weekend in Beijing. But in reality, if you look at our models coming into last week, it was across the board sell from both short and medium term model basis. The short term is 1 to 2 weeks, the medium term is 1 to 2 months. Models like medium term put to call ratio reached strong sell last week, as you can see in front of you now. Lots of other medium term models were generating the same message. Risk appetite, overbought models, all these types of models in the medium term were on sell. Those short term models which were generating sell as well last week have started to move, given how much weakness we've had over the last few trading sessions. So some of them are starting to get to buy, but many of them aren't. So for example, the short term put to call ratio is still very much on sell, there or thereabouts. The short-term risk appetite model, which looks at fear and greed, has though become a little bit fearful, but not meaningfully fearful. So the short position that we put on last week is really starting to pay off. The risk reward doesn't necessarily recommend taking it off just yet. Clearly we're at key levels which we'll be watching closely, but equally all the short-term models are not yet on buy, and it may well be, given the medium-term and short-term message of the models last week, that this is a marked, meaningful change of trend. So risk reward favours playing the short position further, but tightening the stop and guaranteeing profits. For full details of how we're trading this, please see today's Daily Rag, available to subscribers and on the website. So what are we watching today and this week? Well, today the macro is pretty light. New York Empire State Manufacturing Survey is probably the most important piece of macro. This week, though, there's lots going on. Jerome Powell is giving his semi-annual report to Congress on Tuesday and Wednesday, 3 p.m. London time, added to which we have the UK-EU Brexit talks today. It's a key day, it's crunch day. The Prime Minister Johnson is talking with the EU head, Ursula von der Leyen. Negotiations are at an impasse, so today is key. Equally, the Bank of England on Thursday is interesting, more QEs expected, whilst EU leaders are meeting on Friday to discuss that 750 billion euro bailout. How much is grants? How much is loans? Added to all that, we have the Bank of Japan monetary policy meeting on Tuesday. So that's it from us. That's your morning market hit for Monday, 15th of June. Thank you for listening. Please do subscribe on YouTube, LinkedIn, Facebook, and/or Twitter. Thank you for listening. Stay safe, trade well.